Next in my Are Options a Scam series, I will look over the covered call in a grind down market. I've been backtesting strategies for over 25 years, and the goal here is to find a system that is resilient, one that has minimal drawdowns and decent returns. And the standard I use is the S&P 500. If the system can outperform the S&P 500 on a risk-adjusted basis with black and white rules, then I consider that a good trading system. The most efficient way to backtest and eliminate a potential trading system is to take it through the toughest testing periods first. If it can survive the tough test periods, then it's worth backtesting over longer time periods. The first thing I do when backtesting is take the system through all 4 market types to see if it survives. If the system can survive these markets, then it may be a viable trading system worth further testing through years of time. And my experience has taught me that when trading options, there is an edge when selling premium, but when buying premium, a low probability position is created. The low probability positions lose money over time. Therefore, as of now, my options trading scam series will not involve backtesting a long options premium trading system. Some courses and services are solely based on selling well-known trade structures and promising you could make money trading them. This series on options trading scams is dedicated to backtesting the well-known options trading structures. First, I'll need to go over the type of structure I'm backtesting, and then I'll go over the management rules of the test. So first I need to explain 3 types of trading styles. Number 1 is always on. Number 2 is opportunistic, and number 3 is a campaign style. Now I will be using an always on trade style in my backtest. Always on means that the position is always on, much like a long portfolio. With options, when a position closes, I will open a new position on that same day. Now, the second is an opportunistic style, and this is a variable trading style that puts trades on whenever there's an opportunity. A day trader falls into that style of trading as they look for certain patterns, and when the patterns emerge, they open a trade. The third style is a campaign style, which means a position is opened based on a calendar or time frame. A good example of this would be an investment in a retirement account where the money is added to the account on a monthly or quarterly basis, and the capital is applied to add to current positions. Now again, I will be using an always-on trade style in my backtest. In this video, I will backtest the covered call through a grind down market. And I've already backtested the covered call in a bull market and a sideways market, and you can see a link in the description below for those videos. Now, here are the rules for this backtest. It's going to be an always-on trade style. I will use SPY as the underlying. I will own 100 shares of SPY. I will include a commission of $1 per options contract and 0 per share of stock or ETF in the commissions. I will allocate enough positions to use all available regular margin when applicable. I will run the test through all 4 market types, and this video will be on the grind down market. And again, the market types are the 2017 bull market to 2015 sideways market. And this is the 2018 grind down market, which occurred from October 1st to December 31st, 2018. And then the 4th type of market that I will test later will be the 2008 crash market. Now I will sell 40 delta calls that expire in approximately 30 days. I'll wait for the call to expire before selling another call or reestablishing a new position. So here are the back tests with the results. Okay, let's get started here. Our grind down market is from October 1st, 2018 to December 31st, 2018. So we're on Monday, October 1st. Time is 7:15 a.m. We're going to buy 100 shares. And we're going to buy 100 shares of SPY. Their margin looks like about 14,600. Let's go ahead and sell that covered call. 30 days out. 30 days. Around 40 delta. These are both pretty close. Let's go with this one. Okay, and this is on October 31st. Let's go there. 31st. Okay, and this is worth nothing. Let's buy it back for nothing. Okay, it looks like the stock went down. So we don't need to, we didn't get called away. So let's go 30 days out and resell at 40 delta. 39.20. First one. Pick up $3.78. Let's see, when does this expire? On the 30th of November. On the 30th of November. We're going to buy this back. Oh, it's worth 14 cents. Okay, so 276, and we're trading at 274. So we did not get called out. So we're going to buy this back for 0 and hold the stock again. And resell 30 days out. Let's go to the end of the year, December 31st. Which one's closer to 40 delta? They're both pretty close. I'll go with this one. Okay, we'll go to 31st. And it does not look like this has any value. Okay, so get out of this for nothing. And we'll sell the stock. Okay, and now we'll do the, before we run the report, I'm going to go ahead and run the back test on buy and hold. So let's go with buy and hold. Starting October 1st, 7:15. We're going to buy 100 shares. Commit that. And we'll go to the end. We're using about 14,000, let's call it $700 of buying power. Take note of that. December 31st, minus 100. Commit there. Let's run a couple of reports. Okay, here are the results for the covered call. It only shows one trade because I held the stock all the way through and just sold some calls against it. Down $3,494. Let's take a look at this from the buy and hold. Okay, buy and hold was down $4,360.50. Okay, so the covered call did outperform in the grind down. Let's go ahead and look at the calculations, or do a couple of do a little math here. Okay, so we had 34.94. That's how much money we lost with covered call. We started with 14,700. So minus 23.7%. with the covered call strategy. And the buy and hold, we were down 4,364, 360 and 50 cents divided by $14,700, 29%, 29.66% minus. Okay, so looks like we took about a 30% loss buy and hold, and then the covered call strategy, the way that I back tested it selling the 40 delta call, brought it down to only 23.7% loss. So it looks like it wasn't some major loss mitigations, but it did mitigate around 6%. So you did save about 6% by selling those covered calls in the 2018 grind down market. By the way, if you're interested in the software I use to perform my backtest and monitor my positions, it's called Option Net Explorer. And I left a link in the description of my experience with Option Net Explorer and a link for a 10% discount off the product. Also, if you're interested in my free proprietary course, which has been backtested and outperforms buying and holding the S&P over the last 10 years, I left a link in the description below. And hey, don't forget to hit that like button. Thanks.